Well, shares of Alphabet are sliding into the red after missing estimates on the top and bottom lines. The tech giant's revenue growth slowed to 6% from 41% the prior year as ad spending continues its downward trend. Lapping from a strong third quarter last year made for some tough comps across Alphabet's portfolio, including search and YouTube. Take a listen to what we heard from Google and Alphabet CFO Ruth Porat on the earnings call.
In YouTube and network, the sequential deceleration of year-on-year growth in the third quarter versus the second quarter primarily reflects further pullbacks in advertiser spend. In the fourth quarter, the very strong revenue performance last year will continue to create tough comps that will weigh on the year-on-year growth rates of advertising revenues.
Joining us to break this all down, we've got Bob O'Donnell, TECHnalysis Research President and Chief Analyst for more on the impact tech companies are starting to feel from an economic slowdown. Bob, we've got you in the flesh.
It's so great to be back live in the studio. It's crazy.
Certainly a good day to break this all down.
Yeah.
We're going to start with Alphabet because, we were saying before the show that it's interesting to see how significantly they were affected, especially in digital ads. When you think about the last quarter, there was a bit of a divergence between the social media companies.
Right.
Alphabet has a bit more of a diversified portfolio, but they weren't shielded this time around.
No, because obviously Alphabet gets search, and we're always going to search, and people are always going to do that. And so they always have that they can fall back on as part of the advertising side. But the social media side and the YouTube side of things, that's where they took the hit. And that's because we're seeing, obviously, overall advertising going down in those places. And the other challenge that you've got with Alphabet is it's not really that diversified a company, right? There's so much dependence upon advertising. Look, they do have Google Cloud, which, they didn't really talk too much about that, but they have a few things that are bubbling up, but they're still small. I saw a note the other day that, other bets, remember when they used to talk about other bets, it's 0.3% of, the company's revenue. So, I think that's one of the ongoing challenges. They're going to figure these things out. They are building their business not only on the enterprise side, I should say, not only for Google Cloud, but also Google Workspace, some of their other services where they compete with Microsoft. And that's been growing, and it continues to grow. It's going to take a while before it becomes a huge contributor to the bottom line. But there are these elements that are in play and that are moving forward for them.
What was your takeaway, though, from what we heard in terms of where things are headed? It seemed like they were sort of setting things up for an even more significant downturn. And to your point, yes, it's not as diversified as a company like Microsoft, but in terms of where the ad revenue and where they compete in, it is a little more diversified than the likes of Meta or Snap.
Yes, no, it definitely is. And look, I think what we're seeing in a lot of ways across tech is a sense of the things that people expected to happen at the beginning of the pandemic didn't, and now they kind of are. It's sort of like it's a 2.5 year delay of the big impact that people thought was going to have. I think in general, we're seeing that tech companies, having weathered so well, are now facing the challenges that other parts of the market have faced. And it's just, that's the reality. Growth is going to slow down. And on the advertising side, of course, that's a reflection of overall macroeconomic trends. And there's not a whole lot they can do about that. And I think that's a challenge. Obviously, there's not many more places they can go. Google is everywhere and their stuff is everywhere. So it's really going to be dependent upon how the general macroeconomic does so that those companies then feel more confident, their advertisers, I should say, feel more confident in spending the money with a platform like Google.
Let's talk about Microsoft. Obviously, Azure has been the big growth driver there. And you have said in your notes that because it is more enterprise facing, they are a little more shielded. And yet what we heard yesterday, I think it was on the call from Google, saying essentially, yes, companies are still investing in the cloud, but they're taking a little longer and maybe thinking a little harder about how much they want to invest. So are we likely to see further headwinds for Microsoft, even if Azure is the driver?
I think we will. And, the issue is it's easy to forget that only about, I think the last numbers I heard were 15 to 20% of companies have moved their workloads to the cloud. Or no, I shouldn't say of companies, of the potential workloads. And so there's still this huge potential upside to move to cloud computing from all the big platforms. And the other thing to bear in mind is we've had these incredibly strong growth rates for cloud computing across the board. AWS, obviously Microsoft. And at some point, you can't last, right? It's the law of big numbers. You run into a certain point where it's very difficult. The thing is, even as things start to slow down a bit, a lot of companies started big initiatives during the pandemic that are cloud computing based, and they are going to continue those. Like you said, as the commentary said, some of those projects are going to slow down a little bit. They're not quite as high priority perhaps as they were, but they're still going to do it because it's still part of these companies really kind of trying to transform their businesses, and that's an essential part of survival, in the next decade.
We're still waiting on numbers from Meta. We've got Alphabet or Amazon and Apple later on in the week. It's sort of interesting to see how the narrative around tech has changed because for a while it was about the social media companies. And yet when you think at where we are in the current quarter, it feels like we're going back to sort of these established players, if we can call that. Yeah. It has come down to Apple. It comes down to Microsoft. I mean, how are you looking at your portfolio of those tech names, and where are the safe bets?
Yeah, no, I think we are falling back to the most trusted tech brands, and the big names are going to be the ones that are going to, I think, make it through this. The other thing is, again, these companies over the years have become increasingly diversified. Now, in the case of Meta, I think it's a challenge, right? Obviously, very advertising focused, very consumer-based advertising focused, so likely it's going to be tough. Apple, everybody loves to say, well, one of these days, something's going to catch up to Apple. But what Apple magically manages to do every quarter is somehow get different elements of the puzzle to add together. There have been rumblings that iPhone 14 sales, for example, have been lower than expected. So they've, apparently cut the production. And so people say, oh, well, see, iPhone's going to be down. But remember now that iPhone is less than 50% of the revenue. They've built up this huge install base. They continue to sell services, right? Everything from Apple TV and all the other services they have, that's driving their growth. They're also doing more, obviously, with AirPods and the watch and other elements of their ecosystem. So they've managed to create this, I think, pretty diverse story. Similar to Amazon, right? I mean, Amazon is, very dichotomous. You've got AWS, which just cranks out revenue and cranks out, dollars. And then you've got the online sales business, which realistically is probably going to, take a hit if it's going to be like any of the other retail environments. But the question is there enough on the, AWS side to offset some of that? It's hard to tell for sure. But again, it's that story of diversification that these big tech companies have done over the years. And I think we're going to start to see the benefits of that, but clearly at more of a reduced kind of a normal rate, not the huge multiples that they've gotten.
Yeah, a lot of investors are going to be parsing those numbers or breaking down those numbers closely. Bob, great to have you in studio today.
Thank you, Kiko. Great to be here.
Bob O'Donnell, TECHnalysis Research President and Chief Analyst.